Jasmine. This is very exciting for me because this is the first webinar that Phil and I have done together since we merged. We've sent an announcement out January 1st that Whitman Business Advisors and Transition Advisors, of which I was the CEO, merged in to form Whitman Transition Advisors. So this is extremely exciting for us because it's, although we've been working together now for, gosh, over 4 months, this is the first time we've kind of publicly been together in a webinar. So bear with me while I get over my excitement. So, you know, one of the things that the reasons we merged was because Whitman Business Advisors had a much larger pool of services that they offered. I mean, Transition Advisors was primarily working with firms on mergers and acquisitions and internal succession strategies. We now have, as you can see, other services that we offer. So this webinar is not intended to be an advertisement, but I think you should understand where we're coming from and what we're capable of. So if you have any questions while we're doing this presentation, please don't hesitate to put them in the chat box. If it's something that we think is appropriate to answer at that time, we will. Jasmine will interrupt us. And if it's something that we're going to talk about later in the presentation, we'll defer until we get to it. So feel free to ask questions. And I wish I was sitting across a table from each of you talking about these issues and how they relate to your firm. So, you know, it'd be nice to have some interplay while we're doing this. You know, the M&A marketplace for CPA firms has gone through a significant amount of disruption in the last several years. Obviously, COVID-19 was an enormous, the pandemic was an enormous disruption for about maybe two-thirds of 2020. We saw pretty much everything kind of shut down during that time while people were trying to figure out what this all meant for their firms. Well, what we all found was that, you know, for a variety of reasons, I think most firms came out of the pandemic economy in really good shape, and M&A picked up significantly. But that was on top of what was already going on in our profession, which is an enormous amount of change that's going to happen down the road with respect to the services we offer, the types of clients we're serving, and how we're serving them, primarily driven a lot by technology. And then on top of it, then last year, we had 3 PE firms acquire substantial ownership interest in 3 CPA firms, and 2 of those firms were top 25 firms, Eisner Amper and Citrin Cooperman. The other firm is Shellman, which is a very specialized firm headquartered in Florida, and not nearly as large. And so, you know, obviously that's what what we're trying to focus on here today is, you know, what is the impact that we're seeing throughout the profession, throughout the marketplace for M&A with respect to, you know, the impact of these PE firms and what they're doing. That's the primary focus of our presentation. We're going to start off by looking at kind of what happens with traditional deals and what those look like in order to provide a benchmark or something to compare against with respect to what PE firms are doing, and then what non-PE firms that are maybe trying to replicate the PE market are doing as well. So, you know, when I do presentations for associations and so forth, the 3 most popular questions that I get in each of those presentations with respect to M&A is, what's the multiple? The second one is, what's the multiple? And the third one is, what's the multiple? You know, I recently attended a webinar, actually it was a CPA Leadership Institute webinar, put on by a consultant who's tangentially involved in the M&A marketplace, but doesn't really get involved in structuring deals, more of a support function post-merger. And he was asked that question, what's the multiple going for now? And his answer was 150% to 300%. Well, what that told me, which of course to me was kind of an unusual response because it's not exactly how I would have responded to that. What it's telling me is there's a lot of misunderstanding out there about what's going on in the marketplace because of limited information. So if you've heard what Eisner Amper's deals look like, you might come away thinking, well, that's what deals are going for now, when in fact that was a very specialized situation. or if you heard what maybe a wealth management firm was acquired for, you might come away with an impression that that's what everything's selling for now these days. And in fact, that's not actually the case. So before we go on to the next question, Jasmine, you want to pull up the next polling question?
Yes. My impression of the current value of CPA firms as a percentage of fees is, and please select one of the following.
I'm not seeing the poll on my screen, Jasmine.
Yes, it's because you're the presenter.
Okay, all right, very good. Just wanted to make sure it was up.
Yes. Mm-hmm. All right, we have about 20 more seconds. We have about 59% who have voted. All right, we have about 72%. I'm going to close the poll in just a second. All right, I'm sharing the results. 48% said 100%, 5% said 110, 38% said 80, and 10% said more than 100%. More than 110%.
Yeah, more than 110. So maybe 300% is what you mean. So, you know, first off, keep in mind that the multiple is just one part of the equation. So if I told you that you had a choice between two deal structures, and in one deal I'm going to pay you 10% of collections for 20 years, which equates to a 200% multiple, or I'm going to give you 85% of the revenues of your firm all in cash up front, which one is a better deal? So we're comparing the multiple of 200% to 85%. My guess is a lot of you would rather have the 85%. And so when we're talking about, you know, what the value of a practice is, and this can be a whole nother webinar we could be talking about. It's a basket of terms. One of the things to keep in mind here is that, you know, values in the eye of the beholder. So each practice has unique characteristics, and a specific buyer is going to look at those unique characteristics differently than a different buyer would. So the issue is, who is the buyer and why are they interested in that practice? So, you know, we've seen many examples of situations where one practice might have a difficulty attracting, and, you know, very much interest at all from the overall marketplace, but one specific buyer really found that practice attractive, and sometimes in those cases, you know, they're going to make an offer that's substantially above what any other firm might do. So we know what our practice is going for. So, you know, the first thing to consider here is what is driving the M&A activity currently in the CPA firm. Well, by far and away, the number one issue for smaller firms, and I'm going to say that's firms that are, you know, 5 or fewer partners, although I've seen this apply to firms that have as many as 30 or 40 partners, is partner succession. And that continues to be the number one driver for why firms are seeking to be acquired by other firms. You know, the baby boom generation is still in control of most accounting firms. It is not unusual at all to see firms with 5 partners where 4 of them are 60 years old and older, and sometimes even much older than that. The second thing that's adding to this problem, of course, is it's difficult to get talent now. The profession as a whole is having difficulty attracting talent. And on top of it, you know, firms are having difficulty competing with each other in getting the best talent and keeping it. Most firms, you know, are really good at providing services to their clients and are not very good at managing the firm with respect to how to develop the next generation of leaders. That leads to, you know, a lack of confidence in the part of retiring partners that they'll get paid for their interest in the firm. And many of the younger generation are concerned that the liability that's being passed on to them is not something they can afford. So as a result of that, you know, we're seeing a lot of firms pursue, you know, I need to find some way to take this problem off my hands. On top of that, of course, now we have technology, which is becoming an extremely important part of managing any CPA firm, both in terms of, you know, how you provide the service, how you deliver the service, and what service you're actually offering to the client. Oftentimes, those are technology driven. We're seeing competitive pressure from larger firms that are going what we would have considered downstream. So the whole CAS area, which is now probably the hottest service area with respect to the profession in terms of alternative services, is to a great extent bookkeeping. And, so firms like, the top 10 firms in the country, and I'm not including the big four in that, are offering that kind of service where, 5, 6 years ago, they wouldn't even thought about doing that. So, we have a lot of competition. Smaller firms are feeling competition from larger firms for their clients. And of course, now the long-term trend in the industry is that, compliance services are either going to be eliminated by technology or they're going to become less valuable to the clients. And so, a firm that most CPA firms, small firms, live primarily off of tax services, and they're being told that tax compliance services are not going to be worth much down the road. So what this brings, of course, is new entrants into the private equity market because of all this disruption. That's what private equity feeds on, is disruption. They feed on inefficiency, industries that are inefficient, and industries that are fragmented. And so, what the new entrants in the private equity world are saying is, here's an opportunity for you to monetize the value of your firm differently than what you would do if you were selling it in a traditional way. We're going to provide you a significant amount of capital to spur extraordinary growth. And this is one thing we're going to talk about a little bit later here, but one of the things our profession has done a really poor job of is gathering the capital necessary to actually grow at an extraordinary rate. Most of the firms are living off of the capital their partners have reluctantly left behind because they were told to in order to run the firm. Well, that doesn't leave any excess capital that you need for the kinds of acquisitions that many firms are trying to pursue these days. And it results in the kind of deal structures that oftentimes don't make sense because there's no capital, there's not enough capital involved. And of course, the new entrants are also saying, we're going to provide you an ongoing participation in the value that we're going to create together. This isn't really us buying you. It's you becoming a partner. Us becoming a partner in your firm. And together, we're going to build this firm, the value of this firm up, and we're going to share in that value. And then, of course, part of the message as well, there'll be a second bite of the apple, meaning, once we build this up, maybe we'll sell it to somebody else who you'll become a part of, and maybe you'll do it 2 or 3 more times after that. So that's the way private equity works. So, traditionally, firms have approached acquisitions in a sale structure as opposed to a merger. I'll talk about mergers in a second. Acquisitions have resulted in no new owners admitted to the firm. So I want to make sure I make that distinction, because we throw around the terms acquisition and merger kind of interchangeably. They're really different. And I want to make sure we're talking here about a firm that's actually selling, which means the owners of the selling firm do not become owners in the acquiring firm and are probably not going to be there long term. The value is often determined on a multiple of revenues, which is why we talked about the multiple at the beginning. We have this impression that regardless of everything else, my firm should be worth X% of revenues. Oftentimes the deals are done with no down payments, and this is part of the issue of having a lack of capital available to do deals. The payments are oftentimes contingent on client retention, which of course makes sense to most of us because we're thinking, well, how in the heck are we going to pay somebody if we don't keep all their clients? It's interesting because private equity is coming into these deals and not having that kind of concern. And it's because they approach them from a totally different way. Payments are made over 5 to 10 years, and they're often treated as deferred comp because we want to make sure we get the most efficient tax treatment of the deal so that we can maximize the amount of cash flow that we're going to generate from the acquisition. And if the seller stays on in a full-time role, the payments are usually delayed until they're no longer in a full-time role, because we can't afford to pay them for their practice at the same time we're paying them their compensation as if they hadn't sold it. Valuations that we're seeing are trending downward We've seen deals offered as low as 65%. I've seen deals offered lower than that. I saw one deal offered at 35%. That's pretty unusual. But I think 65 to 100% remains the relevant range for traditional acquisitions still. A lot of this is driven by the fact that, there's not as many, the buyer-seller equation is in favor of the buyers nowadays. There's just so many sellers, and there are not as many buyers as there used to be, partially because of the consolidation of the buyers, of the buyer market. Buyers are now asking to retain accounts receivable and work in process and other working capital, for 1 to 2 years following the acquisition. We've even seen deals where the buyers wanted the sellers to throw that in as part of the valuation. So when we talk about a firm being worth 1 times revenues, typically we're not including in that value the working capital. That's on top of it. Well, in some cases, it's showing that it is part of the deal. And we're also seeing the term of payments trending longer. So whereas it used to be standard that all payment terms were usually over 5 years in an acquisition, in a purchase acquisition, nowadays it's not unusual to see terms as long as 7 to 10 years. Part of that is in order to justify, a larger multiple. So if I'm willing to pay you, 7 years at 15% per year, I can get over 100%. That's 105%. Or if I'm willing to pay, 6 years at 20%, that's 120%. And part of the reason for the longer payout periods is to justify a more what appears to be a higher valuation based on the multiple. Again, in traditional deals, the emphasis is significantly on the client base. Who are the clients we're acquiring? What services are they buying? Are those services and clients the kinds of clients that we want to have? We're basically buying revenue because we're not buying the key talent in the firm. They're selling and they're going to leave in a short period of time. So, it's a lot easier to buy $1 million worth of revenue or $2 million or $3 million worth of revenue than it is to acquire clients one at a time that would generate that kind of revenue. It's kind of a no-brainer, quite frankly, the way these deals are set up. And, there's much more of a focus now on the quality and fit of the client base because there's so many more sellers available that the buyers can be a lot choosier. And that's what we're seeing is, I've had our clients who tend to be the buying firm in the transaction tell me, you know what, I've got 8 deals on my desk right now I'm looking at. This one doesn't look like it's going to fit. And, that's a firm that, maybe 5-6 years ago they would have jumped on. So there's just a flood of sellers into the market, and that's creating a lot choosier buyer.
Hey, Terry, I just want to interject. I've even had some of our clients tell me, don't show me any more CPA firms. I only want to see advisory service offerings. So it's kind of interesting. Firms, larger firms don't want bread and butter CPA firms unless they have specific niches or significant cross-selling opportunities amongst the client base.
Yeah, and unless they fit a strategic need for the firm. So, for instance, if they want to merge, if they want to open a market, a presence in another market, that might be a reason they do it. But just to get more standard traditional service-based clients isn't really going to help them. So now let's talk about mergers for a second, just to make sure we cover the base of what traditional approaches are. In a merger, the partners are exchanging their ownership interest in their firm for an ownership interest in the other firm. So generally, there's not cash that changes hands. And I've seen some creative ways of doing this where a transaction, is set up as a sale, and then those sale proceeds are used to let the partners invest in the acquiring firm. So in essence, it becomes a merger even though it technically looks like a sale. But in essence, what we're doing is acquiring new partners. Normally those partners will sign on to the successor firm owner agreement. They're often given, some traditionally given a conditional guarantee of compensation for a couple of years as they become acclimated to the new owner agreement compensation system. And they're often required to make a capital contribution. Hopefully, it's not going to require them to come out of pocket. They can use their existing capital to do that. Their value is going to be captured down the road when they retire. And it's going to be defined by the owner agreement of the firm that acquired them, which we're seeing usually is 65 to 80% of revenues nowadays, or 2 to 3 times compensation, and usually it's paid as in 10 years as deferred compensation. So, you know, the vast majority of deals are still going to be done this way. And even though, you know, some firms are being a lot more choosy about what they'll do, most deals that we're seeing are still structured this way, with some trends in the different way of terms. You know, right now there's only 2 active PE firms, PE-backed firms that are doing acquisitions, and that's, you know, EisnerAmper and Citrin Cooperman. You know, we expect by the end of this year there will be several more. There are rumors about all kinds of transactions out there, and we're quite frankly involved in several of those that are at advanced stage of conversation. But, you know, so unless it's an EA target or Citrin Cooperman target, it's unlikely that, you know, a firm is going to be attractive to a PE-backed firm, and it probably isn't going to be that way unless they would have been talking to you anyway before they became PE-backed. You know, from 1997 to 2001, CBiz, who was the most active of the consolidators, acquired about 150 firms. There wasn't a lot of criteria used to do that. I mean, it was all about, let's build this thing as fast as we can, and it doesn't matter what we're buying. So they were buying firms as little as, you know, $1 million, and then of course then they acquired Meyerhoff and McCann, which was the biggest one that they did at the time. You know, and they didn't matter where they were or what kind of services they offered. Nothing mattered except just getting the volume. It's not like that, and it's not going to be like that with PE firms. So in order to get into a conversation about what PE is doing, I'm going to turn it over to Phil.
Thank you, Terry. And again, it's my pleasure as well to be presenting together with my partner, Terry Putney. It's really been magical, our coming together and making us the single largest consulting firm for CPA firms in the nation. So, so motivations to structure the traditional way. So, you know, you have buyer firms that are unwilling to commit capital, okay? All the deals are back-end deals, okay? They're not going into debt, they're not financing, although one of the things that we're seeing now that private equity has entered the arena, some traditional firms, larger firms, have gone to the bank, taken significant lines of credits only so that they could compete with private equity. Even some smaller firms that we work with recognize, while they may not be able to put up the same level of capital to structure a more traditional back-end deal, they know that they may have to put $1 million or several million up front just to even get a seat at the table. We're seeing a lot of firms saying, I don't want to talk to anyone unless they're going to be putting some cash up front. And there are far and few between that are doing that. But the traditional way, you know, there's minimal risk to the buyer because they're not really financing everything, and they typically shift the risk to the seller. I mean, I've seen a lot of deals based upon collected fees. Personally, I am not a fan of that because that puts all the risk on the seller. I'm in favor of some sort of hybrid deal, but you know, typically I've seen deals where, you know, we facilitate an introduction and help bring a transaction to a letter of intent, but when it comes to due diligence, you know, it's up to the buying firm and the selling firm to sort of do their own due diligence. We expressly, you know, do not get involved in the due diligence phases. We'll help, you know, provide questions that you should be asking and all that. But the intensity of due diligence for a financial arena I've seen is generally pretty weak. That's why you hear some of the horror stories of deals that turned out bad. You know, and you know, I think that the traditional way of doing mergers and acquisitions certainly will continue for some, but as our marketplace gets more educated as to what's now happening with transactions, we believe, and we've already started to see it, people holding their hands out because they know that there are organizations, private equity-backed CPA firms, additional new entrants in the marketplace that are looking to buy CPA firms and tax practices that will come to the table with cash. Next slide, Terry. So pretty much what private equity is saying, and as Terry said, and he'll get into in a moment, you know, this isn't private equity's first foray into the public accounting arena. But it's my belief that both Charlie Weinstein at Eisner Amper and Joel Cooperman at Citron Cooperman, you know, not only them, but their management committees and teams have are onto a formula that we believe is going to work. They've private equity has gotten a much better way than what we've seen in the past. They have capital. And that capital, you know, if you're not familiar with those transactions, imagine this. One day you're sitting there and you're thinking, okay, you know, I have a 7-figure retirement payment. And when I retire, I'm probably going to get that, you know, it's a multiple of my compensation. And I'm going to get it over 10 years. And then along comes private equity. And every equity partner in the firm ends up with a 7-figure check or whatever, 3 or 3.5 times their average compensation, you know, is. And not only that, private equity is truly creating a partnership with the acquired firms because they're not acquiring 100% of the firm, okay? They're acquiring 60% of the firm, which means the firm still has skin in the game. Partners aren't going to go to sleep at the wheel because Terry talked about the second bite at the apple. And that second bite at the apple could be private equity merging into a larger private equity firm, private equity taking this entity public, private equity taking this and finding an organization like the California Pension Board or TIAA-CREF that likes annuity streams of revenue, secure annuity streams of revenue that are both in audit and tax, and significant capital that PE is able to help the CPA firm get involved in other businesses, other business advisory services. So, you know, and typically what we have seen in many of these private equity transactions is a real thorough review of the past, what hasn't worked and what's going to work. And I believe these two firms have got it right. More is on the way. I mean, we're pleased that, you know, we have actually closed a transaction. And a lot of firms out there think, well, private equity might not be for me. I'm a small firm. Well, obviously, you may not be a foundational firm, but as we chat a little bit more, who knows, maybe you might be a foundational firm. But in any event, you know, these larger firms that are looking to, in 3 to 5 years, grow their revenues to $1 billion, have backers, and the pipeline of activity that they're seeing is just incredible. Next slide, Terry. So again, this is we're not going to do it the way we've always done. So it's not like the same as last year audit. You know, it's there are different ways, and Terry and I have been putting our heads together as we've been speaking with 6 or 7 private equity firms that are looking to break into public accounting. It's sort of the copycat syndrome. And there's a reason, why private equity is coming into this space. And the reality is private equity has shown, and I'm sure all of you out there have clients or may have clients that have been involved in a private equity roll-up, and you hear of your client getting crazy multiples, and then in some cases, that second bite of the apple. They know how to create, they know how to capture value. Next slide, Terry. Now, obviously, you know, with the private equity groups coming into public accounting, a firm has got to be reorganized as an alternate practice structure. And I happen to know, you know, a number of attorneys out there and have worked with, you know, one that I truly believe is probably the foremost expert when it comes to alternate practice structures. So pretty much, because in many states, I'm sorry, in 4 or 5 states, if you're not a CPA, you can't own a CPA firm. And even in the states where you can have non-CPA firm ownership, it cannot be a majority of percentage of ownership. So, and you cannot have non-CPAs owning a piece of the attest services. So pretty much what happens is the attest service function remains typically in both Eisner Amper and Citrin Cooperman's case. That's the legacy firm. Eisner Amper provides the attest services. Everything else, consulting services, tax planning, becomes part of a new entity. And in their case, it became Eisner Advisory Group. And that advisory group, there's typically a management company that participates, and that's where private equity sits. And all the revenue from the advisory group and the attest services firm gets sucked up into that holding company, let's call it, where it's either through an employee leasing arrangement or management fee that most of the revenue is sucked out of the attest firm. You may only have 1, 2, 3 employees in the attest services firm. Everyone else is going to get paid through the advisory group firm. But I'm getting a little bit granular there. You do need to break out and be in an alternate practice structure, and that's best left for the attorneys that have familiarity with that. I believe there's a couple of different ways that can be structured. But, as I said, the CPAs own and operate the attest firm. The non-CPA firm buyer owns and operates a separate firm, and the revenues get sucked out. It's very seamless going to market. They're still going to market as a unified group. Next slide, Terry.
I think I'm going to skip this next slide because you just already talked about it. So I'll go to this one.
Yep, thank you. So the private equity model obviously is a much more entrepreneurial approach. And as I said earlier, the key is, in some of the prior deals, we saw many years ago when CBIZ merged in their New York City firm, and the partners got a very lucrative multiple. And while they did have an earnout, they got significant cash up front. And many of the partners kind of went to sleep and sort of rode out, and truly weren't motivated. I think the approach that private equity has come up truly is a more entrepreneurial approach, and the partners have been incentivized to continue growing the organization. And the way that they've done this is in each of the deals that we've seen. We have been working with Citrin, and hopefully in July we'll close our first transaction with that private equity owned firm. But both of the private equity owned CPA firms offer their partners, they call it different things, but essentially a number of shares or units, let's call it stock or phantom stock, in the private equity group. And this stock is valued on a quarterly basis. And at the date of the deal, that stock was valued at $1. So imagine this, you're a $5 million firm and you merge in, and you know what, that multiple you might get as not a foundational firm may be a multiple of 1. And you may get $5 million, some combination of $5 million at the closing of the deal. It could be $4.5 million in cash and $500,000 of stock in the private equity group. Now, you might say, yeah, what's so great about that? The private equity bet, though, is that in 3 to 5 years, that stock that you got will at the very least double, possibly triple. In some cases, I've heard quadruple. And in one case, I've heard their expectation is even 5 times. So now imagine this, you got 4.5 million in cash, and that 500,000 of phantom stock you got 3 to 5 years later is worth anywhere from 3x to 5x. Now figure out what the multiple that you really got. Just do the math. But it truly is a true partnership. You know, private equity groups typically own other business service models. I know that, you know, in both cases, the private equity groups, you know, with billions of dollars of investments, you know, who do you think they're driving the accounting and tax services for their other portfolio companies to? In most cases, it's going to be that foundational firm. And they'll also be adding other advisory service offerings. Terry, I think you're going to talk about some of the previous attempts now.
Yeah, so I was actually involved in the consolidator model back in the late 90s. My firm was a first firm acquired by H&R Block in 1998, and within 15 months, we'd acquired McGladrey and Pullen, which took us from my little $6 million firm to a $500 million firm. And at the time, there were, you know, 3 active consolidators: American Express, CBiz, and H&R Block, which was operating as RSM McGladrey in that subsidiary. There were probably, I don't know how many. I mean, I was at a conference in Naples, Florida, where there were, you know, 8 more firms that were potential consolidators at the conference who were pitching, you know, a huge audience that the AICPA had pulled together. None of those actually materialized. UHY is actually a survivor of that, an original attempt to create a publicly traded consolidator, and that didn't work. And UHY, the firms that had formed that consolidator, pulled out and rebranded as UHY. CBiz is the only one that survives of those 3 now. You know, there's many similarities to what you're seeing with the PE firms now with what we were doing back in the late 90s and early 2000s. But the key differences we're seeing are the PE firms have learned from what failed back in those days and are doing some things that are dramatically different. So one of the things that you're going to see is that, you know, no CPA firm, the way it's operated today, has EBITDA. There are a few progressive firms that I've talked to where they actually split out part of their partner compensation and consider that EBITDA, and some of that might be retained by the firm, and some of it might be distributed as a quote return on investment. But most firms, you know, don't bother to do that. So all of the compensation that's paid out basically strips out all the profits, and so there is no profit. There's no value from a PE investment perspective. So you have to artificially create the EBITDA, and that's what we did back in the consolidator model. Is we had a formula that said we'll take 35 to 40% of the partner compensation and consider that the return on investment. That's what we'll capitalize. And so if we're going to pay you 6 times EBITDA and you've got a, say, a you know, 40% profit margin, and we're talking about a 40% haircut, that's, you know, 6 times 16 is roughly 1x, and that's how we got to the value. The consolidators would buy 100% of the firm. The purchase payments would start immediately because that's how we justified that by, you know, basically carving off 40% of the profits. And we still use seller financing, usually for up to 5 years. And one thing that was different in those deals compared to what you see in traditional deals was they were all asset deals, so there was a better tax treatment for the sellers. This is the most key thing, though, that happened, and why these firms, consolidators, failed. And although CBiz has not failed, but why Amex and H&R Block did, was basically we took entrepreneurial partners who are driving the growth, driving the culture and everything in the firm, and basically converted them into employees. And I can tell you from H&R Block's perspective, they saw RSM McGladrey partners and all the rest of the employees no differently than they saw all the other 100,000 employees H&R Block had. I mean, you're employees. You work for a public company. It's a very corporate environment. You're expected to perform a certain way. And, you know, there's going to be incentives to do that, but, you know, that's how you do it. And basically it took away all the incentives that CPA firm partners typically have for growing the firm. And as a result, they couldn't grow the firm enough to overcome the haircut. So that 40% cut in pay would have worked if they'd grown fast enough to get back to where they started quick enough, but they never got back to where they started. It never materialized. And in the case of American Express and H&R Block, these divisions were actually poor performing divisions because they weren't throwing off the kind of profits to H&R Block that their core businesses were. And as a result, they exited the strategy. So American Express sold American Express Business and Tax Services to H&R, actually to RSM McGladrey in 2005, I think. And then the partners of RSM McGladrey acquired the firm back from H&R Block in 2011. Now, CBiz has, adapted better than those two did and is very successful these days. But it took them, 25 years to get from where they started to where they are now, which I would consider to be very successful. Phil, what do you see private equity doing differently?
So with private equity, it's basically the same concept as it relates to the haircut when it comes to compensation. EBITDA needs to be created. So I think what everyone really should be doing, and it's kind of interesting, when you look at private equity or investment banking in almost every other business, you don't look at a multiple of gross revenue, you're looking at EBITDA. But because everything is distributed out in CPA firms, in most CPA firms as compensation, there's no such thing as EBITDA. What I would challenge everyone out there to do is to start looking at your compensation structures as follows. If you have a partner that's earning $500,000 a year, okay, perhaps the reality is that work could be done by a either new younger partner or senior manager or director, probably at a compensation of, let's say $250,000 to $300,000. So the reality is, as a partner in your firm, your compensation is $250,000 a year. And the fact that you get $500,000 on your K1 at the end of the year, the other $250,000 is really a distribution of profits to you. Now, obviously, when you do a deal with private equity, no one is going to give you a 50% haircut. The haircut is pretty similar, obviously higher earning partners are probably going to take bigger hits than younger, newer partners in these transactions. But, in the New York City area, if you're making $1 million a year, chances are your compensation is going to go down to $700,000 or $750,000. They are willing to be flexible on this. And, in some of the transactions, we have negotiated on behalf of our clients where, you're still going to be part of growing the firm. So it's not a cookie cutter model. I believe there's the ability to negotiate, and whether it's business development incentives, additional services rendered to your client base by joining that larger organization, private equity owned firms will reward firms for that. But at the end of the day, the reality is you're taking retirement benefits off the books, and by not keeping, by not taking 100% of the equity in the firm, again, keeping the partners in the game and getting them to continue to go out there and strive to see that phantom stock. There's also options that are involved. It's very complicated, but in any event, see those add-on benefits grow at a multiple. Next slide, Terry. So let's continue what private equity is doing. Obviously, they do commit a significant amount of capital in the transaction and a lot of upfront cash, taking the retirement benefits off the books, and part of that is, a lot of managing partners came to me and said, yeah, but what's the opportunity for my younger partners? And many of you probably have younger partners and you're questioning, can they carry me out? Can they continue the firm once I'm gone and ensure that I get paid out. And there's some risk in that. And what I say, the big advantage to a younger partner in a private equity transaction, shoot, I wish I were a younger partner and not an older partner, because here's what happens. I don't got to pay out those senior partners. Somebody else is doing it. The liability of, the thought I used to tell people, do you want to buy high and sell low? Because who's behind you? You got to look at your bench. Well, that disappears because those retirement benefits are taken off the book. And those younger folks, those younger partners have tremendous leadership opportunities as the firm continues to transition. And they're going to be the ones that are not only going to get a second bite at the apple, but potentially a third and even fourth bite at the apple. So, private equity will help firms invest and, be technologically bleeding edge. Obviously, there's a lot of technical investment that's going on in our profession. And, the cost of capital, if you're a small firm or even an independent mid-size or larger firm, that's coming right out of your partner earnings. Now, private equity is looking to get an extraordinary return on their investment.
I'm going to move to the next slide, Phil, because we're running out of time. Go ahead.
Yep, absolutely. That additional services that they'll be able to offer, clearly with partner incentivization. I think anyone that comes and says, well, why would I want to go from earning, $1.5 million as the managing partner of a firm to making $1 million a year? Why would I want to take a significant haircut? And the answer is that second, third, and fourth bites at the apple. As it relates to multiples, what I can say is we are seeing 6 to 10 times EBITDA in private equity transactions. And
primarily for the foundation firms, right?
For the foundational firms, yes, thank you, Terry. And when you look at that right there spells out to you why private equity is coming in. I introduced a friend to who's in the insurance business. He had $500,000 of EBITDA. It was a small, PNC health insurance. He sold a bunch of things. He did a deal with private equity. He ended up getting a 10x multiple. He had no idea his business was worth that much. Then I later found out that the larger the EBITDA in that industry, there are some in the insurance business that are getting a 15 to 16 times the EBITDA. The cost for private equity getting into public accounting as a multiple of EBITDA is relatively inexpensive. Next slide, Terry. Obviously, what you're all here for, we did talk about, so what has the impact of private equity been on the non-private equity market? So we continue to see with smaller firms and excess supply and declining demand, declining multiples in the smaller range. Now, if you're a firm that's under $1 million, yes, you've got a $400,000, $500,000 firm, will someone pay you $750,000, $800,000 for that practice? Yes, there's absolutely a lot of competition in that smaller end of the market. But once you're above $1 million in revenue, if you're just a bread and butter firm, you are not going to see robust multiples. If you're a foundational firm, my understanding is foundational firms can fetch anywhere from 125 to 150%. Now, they're not buying 100% of the firm. So, do the math. But highest multiples are found in largest metropolitan areas, New York City, Chicago. Everyone knows the primary geographies. And obviously, in the non-private equity market arena, what we are seeing is specialty firms are still fetching a premium. We did a transaction with one firm where the firm that was merging in did, I want to say 65 or 70% of all the tax work for all the shows on Broadway. And I believe that fetched a multiple greater than 1. but I have not, in my 14 years of doing this, I started in 2008, seen a multiple greater than 1.15. With private equity, I truly believe that you will see significantly greater multiples, perhaps not day one of merging in with that private equity firm, but once that second bite at the apple happens and that phantom stock is doubling, tripling, or even quadrupling. Now, private equity, you know, are not the only new players in town. We were recently engaged by a publicly traded company. That publicly traded company buys businesses the way Berkshire Hathaway does, and they're long-term holders, okay? They are looking to pay cash, they're looking to get into public accounting. We also have private equity firms now that are willing to do minority investments in CPA firms. Some of them are long-term holders. They're not looking for that hold 3 to 5 and flip. They see the CPA firm arena as a tremendous investment opportunity with a constant stream of annuity revenue that, structured correctly and with the additional add-on services, providing a very nice return. And they will be long-term holders, and they don't need to hold in excess of 50%. I do believe, as Terry said, that you know, this private equity invasion that we're seeing is going to continue. I believe by the end of this year, we will see a minimum of 6 private equity firms, perhaps even closer to 10, as well as significantly more wealth management firms buying tax practices and publicly traded companies coming into this arena. Because this is a business, if capitalized properly, the sky is the limit. And you know, when every investment you make, from hiring that $250,000 employee to having to revamp your entire technology platform, when those dollars are coming out of the owner's pockets, and you have a diversity of ownership, younger partners that are looking to monetize, younger partners that are looking to grow, I mean, it's very hard to make those investments. It's my opinion that we're going to continue to see an aggressive invasion of other buyers in the CPA firm marketplace. And this could be tremendously positive for you. Terry?
Any questions? Did we get any questions, Jasmine?
Yes, you did. Give me 1 second. And we have one more poll to do as well. So the question we have is, can PE deals work for a 4-partner firm with 2 older partners and 2 younger partners?
So Terry, I'll take that. And what I can tell you, the answer to that is absolutely yes. So the way I see it, the 2 older partners, that's sort of one transaction. You know, they obviously want to cash out, and that typically is very accretive, especially if the work has been transitioned. The 2 younger partners will also receive a benefit because, again, it's not just going to go to the older partner group, although typically what we see is the older partner group, if you have a managing partner, are usually be the ones that are going to allocate how much goes to each of the partners. But with a much longer runway, for the younger partners, it should be equally attractive as the older partners. Terry, I don't know if you want to add anything.
Well, it assumes that the firm that you described would be attractive to a PE-backed firm. I mean, the firm you described, if it's a, you know, the deals we've seen done as tuck-ins have been around 5-6 million on up. Is that right, Phil?
Yeah, although we are working with one firm that's 3.5 million in revenue, but they have an expertise in international tax in Latin America. So again, where there's a specialty, a firm typically will, you know, at first when this happened, I thought this was only for the largest of firms, but I think there's an opportunity for, you know, an entrepreneurial firm with niche specialties, perhaps not to be the foundational firm, but most certainly to be in the sights of one of these larger firms that are already PE owned.
Right. I agree. Any other questions, Jasmine?
No other questions, but I'm going to launch your last poll question. And it says, in the next 5 years, our firm is most likely to, and I just distributed the poll. So everyone has 30 seconds to answer. Thank you, everyone, for your prompt response. I'm going to leave it up for about 10 more seconds. All right, I will be closing the poll. And the results were 8% said sell, 42% said acquire a smaller firm. I'm sorry, 42% said acquire a smaller firm, 13% said merge into a larger firm, 25% said not sure, 13% said do nothing with M&A.
All right. Well, thank you all for attending, and I'll turn it back to Jasmine. Phil and I very much enjoyed having this opportunity.
Perfect. Thank you, Phil and Terry, for a great presentation, and thank you everyone for joining us today. I'd like to remind you to complete the exit evaluation for this webinar, which will appear as you exit. Your comments and evaluation of this session are very important to us. Certificates of completion will be emailed within 10 business days. You will find a link to download or print the PowerPoint slides along with the recordings on our website under Member Resources, Webinar Recordings and Slides. We hope that you join us for future webinars. We encourage you to review our entire course catalog at cpaleadership.com and register. Thank you so much, everyone. Have a great one.
Thank you.
Thank you.
Thank you.